Hey everyone, welcome back. Today we're going to be looking at a very simple strategy, the 0DTE Strangle. Really kind of a simple setup. We're going to sell a whole bunch of contracts for a very little amount of money first thing in the day, and then a couple of hours later we're going to buy it back for a smaller debit than we initially collected a credit on, and hopefully we make a couple of bucks. It's a very high risk trade for very low reward, and I want to see if it's worth it. Hey everyone, welcome back. My name is Levi Woods. This is Drawbridge Finance. Remember, this is not financial advice in any way, shape, or form. This is just my personal opinion. Now, today we're looking at a very simple setup, which I believe is a pretty high risk strategy. So I'm going to caveat that right out of the gate. Now, the reason that I'm doing a video on this is because I belong to a Facebook group, and there's a couple of really great traders in there. And this particular group that I am involved with is on conservative option trading. Now, there was these posts that were popping up, and they're called like lunch money trades. And basically the idea is that they're very, very small reward trades, and they're held for a very short duration. But what you can do on underlyings that have Monday, Wednesday, Friday expirations is you can use the same capital 3 times per week and get in a situation where we're making small amounts of money just to cover, that Friday lunch or beer money for the weekend. And when I was looking at some of the data from these particular posts, I started to comment on them because I didn't think that they were really appropriate for conservative trading. I mean, the risk is massive. If we sell multiple contracts, what happens in that outlier event that is completely uncontrollable? And when we're dealing with naked options, if the market does move in one direction or the other, we have risk to both sides, and the gains that are small could be just completely wiped out, and we could blow up an account. And so I wanted to, make a comment and make a video about this type of trading. So let's take a look at some of the data. I wanted to say thank you to Mike for sharing this information on the Facebook group, because I think that this information is fantastic for new traders. Now, in this particular post, he said, IWM trades this week. Pennies grow up to be dollars. All trades relatively low risk trades. Now, you can see there's tons of transactions. September 2nd, there was some trades. August 31st, there was some trades, and then on the August 29th. So this is really just 3 days in the week that are split up, and the total profit for the week worked out to $484, which is fairly substantial amount of money. I mean, if you could make 485 bucks every single week, that would be pretty good return at the end of the year. So let's break this down a little bit. So the idea here is that he's selling many out of the money options early in the trading day and then buying them back for less money later in the day if the underlying hasn't moved. So what I've done is I've highlighted here all of the trades that happened only on August 29th. So this would have been a Monday, and a pretty simple setup. What we can basically see is happening is these highlighted in green. In the morning, they're selling 10 contracts of the IWM August 29th, 2022 183 put and collecting 8 cents. Now there's a $5 commission. The total after the regulatory fees worked out to $74.88. Now this is a credit because this is a sell, right? Sell to open. Now later in the day, buying back 10, so the same quantity that we sold in the morning, same contract. So we're selling for 8 cents in the morning and buying back later in the day when it's only worth 2 cents. Now, the reason that this happens is because the stock price hasn't moved. When a strangle loses value, which is what we want it to do because we're selling it for a credit and then buying it back for a debit later, if it stays within the range. So in this case, on the lower side, we wanted the stock to stay above 183, which it did. Now on the call side, we wanted to stay below the calls. So the calls that were entered were very similar. They're the same amount of contracts. They were just split over 2 different positions. So sold 5 of the IWM August 29th, 2022 191 calls for 9 cents, and then sold 5 of the 190 calls for 25 cents. We can see that the net credit received was $121 and then $42. And these were closed later in the day for a debit of $107 and a debit of $15. The smaller trade actually made more money. This bigger trade, the 190, actually only made about $15 total from 122 to 107, which is not a massive return, but overall it adds up. And that's the whole idea with these particular trades. Now, all I've done is move the data from the bottom of the screen up and consolidated it. And I want to just look at these 3 trades to do some calculations. Now, the opening price at the beginning of the day on August 29th was 186.95. And basically there's 2 trades that are happening. There's the opening of the 10 put contracts. The total premium collected we know is 74.88. But what I want to do is I want to calculate the break even. I want to know, when do I start losing money? Because I could lose pretty rapidly on this trade. To calculate the put break even, all we do is subtract the 8-cent credit from the 183 strike. So we can see that if the stock starts trading below 182.92, we're going to be in a loss zone, and we're going to start losing actually pretty rapidly. We have 1,000 shares, 10 contracts. So if this stock goes into a free fall, there's not much we're going to be able to do but close, and it's going to be moving against us very, very quickly. Now for the call side, there's actually 2 different break-evens because there's 2 different contracts. There's 5 at the 190, and for those ones, the premium collected was 25 cents. So this one gets added to it because it's to the upside, and the break-even on those 5 contracts is 190.25. And we would have 500 shares that are losing dollar for dollar, penny for penny as the stock goes up above 190.25. The other 5 contracts have a 191 strike, and they collected 9 cents. So the break even on those is 191.09. So to think about this, you've got 500 shares that start losing money if the stock goes above 190.25. Then we have 500 more, so a total of 1,000 that will be losing money at any price over 191.09. And again, the up moves are less likely to be very, very fast velocity, but they can happen. So now on the trade opening, we can calculate the max potential profit, which is going to be $239. Now this is important because I'm going to use this calculation to figure out how much money I could make on a daily basis or how much I could lose relative to this number, because the max potential loss on this trade is unlimited, and that is very important to understand. So this is really what I want to know, is how much risk am I taking? How much do I lose if the stock goes back up to the previous day value if it's a down day? Or what if it goes to the equivalent of the largest historical moves? If it just completely falls, I want to know how big this loss could be, and can I completely obliterate my account in a single day of trading? So I pulled up some information on TradingView, and there's a few things to look at. The first thing is this green zone. This is the area where the max potential profit is going to be. So if the stock stays between 183 and 190, that's the maximum return, is this zone. It's actually pretty big. If you look at it relative to the day before, which is this large red candle here, this day was pretty big. Well, it corresponds to the same height as this green range, which is pretty good. And remember, the trade gets entered in the morning, so we can calibrate it and center it exactly where we want it, depending on our assumption, if we want to be neutral or bullish or slightly bearish. The next thing I wanted to look at was what happens if the stock, which opened here, moves all the way back up to the top of the previous day's candle, which was the previous open. Now you can see that the net loss would actually be $4,700 in this case. So it's actually pretty substantial. Remember, the maximum profit is only $200. And if it just moves up to the previous day's value, I could lose $4,700. But it is not actually that crazy. It's a 19 times the max profit, or it's the equivalent of 9.7 weeks of profits if we were basing it on $485 weekly return. Now on the downside, if we use that same candle height and we went down here, how much could we lose? Well, it's actually a little bit less risk on the downside. If the stock dropped down to 182.33, it would only cost $670 to get out of the trade. We collected $239 at the top of the trade, so it results in a net loss of actually only $431. If we use the previous day's candle, then, and we say, what if it went up? There's actually more risk than if it went down the same depth, which was quite interesting. This was interesting information for me. And we can also see that the total loss is 1.8 times of the max profit, or 0.9 the weekly returns based on a $485 weekly return. But what I really wanted to know was, like, what happens in the catastrophic event? So what I did was I went online and I looked up the biggest single day moves of all time in the Russell, in the IWM. And I just looked at what the percentages were, and then I calculated it out to see what they were. The second largest drop of all time in the Russell 2000 history was on October 19th of 1987. So this is a very, very unlikely event. It was a 12.5% drop. Now, from these current levels, that would put the stock at 163.52. If the stock was trading there, the cost to close those 10 contracts would be $19,482. This results in a total net loss of $19,241. Now, the interesting thing about this is it wasn't nearly as big as I actually thought it would be. This move takes out 80 times the max profit returns, or 39.7 weeks of profits based on a $485 weekly return. So the second largest drop in history, in the entire history of the IWM, didn't even take out a single year's worth of profits on a trade like this, which was way less than I thought. I was expecting it to take out a number that was like 20 years worth of wins or 15 years worth of wins on these extremely, extremely huge outlier moves. Now let's look at the biggest drop in history. If the stock dropped 14.27% down to 160.08 a share, this was the largest recorded single day drop, which was March 16th of 2020. So it was actually pretty recently. If the stock dropped there, the cost to close would be $22,000, resulting in a net loss of $22,681. This is 95 times the max profit, or 46.7 weeks of profits based on that $485 weekly return. All of a sudden, I'm looking at this and I'm thinking, well, this is not nearly as bad as I thought. Even the largest single day drop, which is completely unexpected when that kind of thing happens, and it's so rare, doesn't wipe out account completely as long as this trade is done consistently. So let's take a look at what actually happened on the day. Obviously, IWM stayed in range, and later in the day, there was a debit to close, and we can calculate this out. The cost of closing these 10 contracts for a price of 2 cents each, there was zero commission. The total amount was negative, or debit, of $20.10. So the realized profit was the $74.88 credit that was collected minus the $20.10 debit to open, resulting in a profit of $54.78 for the put side. Now, closing the 10 contracts, we can do the similar math. We paid a debit to close of 107 and a debit to close of 15, resulting in a net debit of 122 from the initial credit, which was 164, resulting in a realized profit of $42 from the calls. So the calls made slightly less money than the puts did in this case. The total realized profit for the day was $54.78 from the puts, $42.28 for the calls, resulting in $97.06 total. Pretty decent for a little trade that you're only in for a couple of hours. From my personal evaluation of this, I think there's quite a few pros to this type of trading. There's no overnight risk at all. So you're just such a short duration. I mean, it's really only a couple of hours that you're holding the trade. And if there's a particularly volatile day, like when Powell is speaking, we know that there's going to be a large market move, or there's some sort of crisis that breaks out and something's going on, we can just choose not to open the trade, which is pretty awesome. I mean, lots of times the market opens, a volatile move has already happened, or part of it has already happened, because there's quite a few hours when the market's actually closed. Now, the cons to this trade are pretty big as well. There's very little defense. If something was to happen catastrophically, there's nothing we can do. It's just a free fall, especially to the downside. The only thing we can do is close. But even on these largest moves, they were not that big. The other con is that they're a low reward relative to the high margin requirement. So that's a major problem, because it takes a huge amount of capital to only make about $100. And of course, it led me to want to test this more and more. Like, doing those calculations manually was not that much fun. And what I ended up doing was upgrading one of my spreadsheets. Now, this is a spreadsheet that's been available on my website for a while. If you pop over to drawbridgefinance.ca, you can look for this spreadsheet here. It's called Backtesting Stock and ETF Averages. Now, I originally built this as a weekly tracker, and what I did was I added a second sheet, and it's pretty great. It tracks the last year's worth of data daily. It pulls the worst performing 10 days of the year. It shows whether or not the following day was an up or down day. It tracks the 10 best trading days of the year to see where the anomalies occur. It charts out every single day so we can see visually where these big up and down days were. Then it clusters it and it shows the standard deviations with one standard deviation and 2 standard deviation moves highlighted in yellow on the chart. It also tracks the price over time. It's a very, very complex sheet. And what it does is it specifically allows us to target the upper target limit and the lower target limit based on the previous day's close. Now, this spreadsheet definitely requires its own video by itself, so I'm not going to bore you with those details. If you don't already subscribe, make sure that you do so you can watch for that video where I'll explain all the nitty-gritty of how that works. I also think there's a modified strategy to this after building this spreadsheet and looking at some of the parameters and when we see these outlier moves. And I've actually been not trading strangles the way Mike has been doing, but I'm actually trading a slightly different trade, which my patrons know about, and it's been 100% successful since I started putting it on this month. It's been pretty wild, and I can choose if I put it on Mondays, Wednesdays, or Fridays, and we haven't had a loser yet, which has been pretty fantastic. Now, if you enjoyed today's video, remember to give me a like. It helps the channel a ton. Leave a comment down below so we can all get rich together. Thanks so much for watching, and see you very soon.